everybody, and welcome back to Let's Chat with Jen and Angie. I'm Angie.
And I'm Jen.
And together we are Heart and Home Legacy Group with Edina Realty. Today we are going to be talking about interest rates. The big question that everybody is wondering is what's going to happen with interest rates. We're going to touch on tariffs a little bit, and we're going to talk just about where things are at right now in our world and economy and the housing market. To do all of that chatting with Jen and I today, we have Jim with Cardinal Financial. Welcome, Jim. We're so glad to have you.
Thank you very much, guys. Look forward to having this conversation and appreciate being here.
Yeah.
Thank you.
So Jim is a loan officer, has been in the industry for some time now. We've had lots of different clients having wonderful experiences, and so we wanted Jim to sit down with us and talk about interest rates, where interest rates are going, where are they right now? You know, we just got done with 3% interest rates.
Right. Nope.
That doesn't ever happen. And so now they're up to 7%.
Close to 7, 6 3/4 to 7 range, absolutely.
Yep. So tell us a little bit about rates. What are rates doing?
Yep.
Where do you see rates going as a loan officer? Just spin it all to us. Like, how do you keep up with it? And how do our clients get the best rate?
Have these conversations on a daily basis. First of all, I wish I had a crystal ball to be spot on as far as what rates are doing, but that crystal ball has been taken away from me. So I'm basing this on market knowledge and everyday work. As far as the overall outlook on interest rates, looking about 12 to maybe 18 months out. National Association of Mortgage Bankers is predicting around 6 to 6 1/4.
Okay,
right?
So interest rates dropping to 6 to
Yep.
6 1/4.
Which is good news, which I think will be a huge positive for buyers that are sort of on the fence right now, whether it's because of the actual payment or just psychologically, that's preventing some people from taking that next step, right? But 6 1/4, possibly 6 for the next 12 to 18 months. And who knows, that could be 6 months from now. That could be 9 months from now, right? It all depends on what's happening with our U.S. economy.
Yeah, and realistically, with your expertise, when is the best time to buy? I get that question 3 times a day. Should I buy now or should I wait?
Very good question. But obviously, if you're in a position or a need to purchase, I always tell my clients, now is the time, right? My objective is to get a client, obviously, they need to be comfortable with the payment, the costs associated with purchasing a home, et cetera, et cetera. But I'm telling all my clients right now, if we get you into a house now, this is your temporary loan. So presuming that, everything's good, you can afford the payment now, it's only going to get better because it's inevitable that rates are going to drop. So if you get in now at 6.75, 6.875, 7%, when rates do drop, 6, 9, 12, 18 months down the road, for my clients, I'm going to pick up the phone. Mary, we locked you in at 6.75, a year ago. Rates are now at 6 or 5.75. Let's take a look at the numbers and what that would look for refinancing.
And see if that drops your payment, if it makes sense.
Yeah, absolutely. Yeah. And I laid all those options out. I laid those options out now with my clients, what the future would look like as well. Right? So they know if they refinance down the road at a half point lower, 3/4 point lower, a point lower, what those payments are going to look like.
Yeah. So what you're saying, just for those of us that are listening that are not as affluent and it needed to be broken down a little bit, what he's saying is that you could purchase now at 6 1/4 or 6.5 or whatever the interest rate is, with the understanding that if they drop to where it makes sense for you, you can refinance. So your payment isn't going to your interest rates. The only way that your payment could increase would be, of course, insurance, taxes, things like that.
Correct.
But so that's just to keep that in mind that you can utilize. And that also comes into people's equity, which is another part that Jen and I wanted to talk about today, and we can touch on it a little bit later. But you'll have equity then in your house. You're growing your equity, so you can just know that you're always going to have that in your pocket.
And that's one of the reasons that we have Jim on the show today is you don't have to be the expert. We at this table are the expert. You don't have to remember what your interest rate is. We will remember what your interest rate. The 3 of us will call and tell you, hey, you purchased your home at this interest rate. Now the interest rate is this. Let's get you a hold of Jim. But Jim does that for you, and that's why he's partners with us. That's why we work together well, because once you become in our circle, once you become our clients, you're our clients for life. And that's why this is important, that we are in the weeds of lending and agents and sales in the housing market and study this for hours a day to make sense of all of what's going on in the market. So you don't have to know all the numbers and all the nuances, because that's what we have Jim for.
Yep. So, yep. Jim is the one that, as long as you are walking away from your approval process with Jim, feeling comfortable with the payments, meaning that's the price point that we can look at, then we're set for success. And then in the future, you could choose to refinance. But again, it always comes down to rates and what's going to happen with rates. And in real estate, there's nothing more common than change and having to pivot. Like they said on the movie Friends. Pivot. You got to pivot.
Oh, boy.
And I'm definitely pivoting right now. Yeah.
So in regards to interest rates, then it can go into talking about other parts of the market. Is there another part that you wanted to touch on as we go into the next part of the conversation?
Well, I was just going to mention, as far as interest rates as well, there's the key interest rate that, we would work with you, that the market rate, if you will. I'm not going to get into a lot of detail, but I want buyers to know it's also an option to buy down interest rates. So if the par rate is, you're locking in at 6.75, there's an opportunity to get that rate down to 5.75, whether the seller of the home that you're buying pays for it, or you pay for it, or both of you pay for it. So there are options for lower than market interest rates with the appropriate strategy. So that's, does every buyer look at that and take advantage of it? No, it has to be the right situation, based on overall need. So overall comfort level and what you have available to you. So yeah, it's an option.
Sure.
And that goes, again, with my buyers. When I'm talking to my buyers, a lot of the time when we're sitting down for that first time, it really goes back to what is the cost of the home? What is it going to cost me to buy that home? But on the flip side, what is that payment going to look like? So you're kind of going back and forth. Yes, what's the cost of that home? But what, at the end of the day, what does that payment look like for me? And that's where that interest rate comes in, because that's where we get with Jim. And that's how we decide what kind of programs there are, what kind of loan types there are. I mean, there's so many things. I can't even say all of them, but lots of programs out there that we can use.
I would just say adding overall perspective to interest rates, which you guys know, most people have come across this conversation. Yes, rates are higher right now than they were. People cannot stop comparing rates to what they were during COVID. 2.75, 3%, 3.25%, right? COVID was a once in a generation probably event that brought those rates to us. But if you look at interest rates historically over the last 50 years, go on Google, Google historical mortgage interest rates. You'll see the ups and downs, and you'll see that today's rates kind of just fit right on in with the overall average throughout the years, right? So it's all about perspective as well.
And another part of that perspective too is coming down to, how do I word this? Like prices. So we've had interest rates where they've been astronomical and they've been really high. And now we've got them more about 6%, but then you're also incorporating housing prices. And that's another part of the current market. Housing prices during 2008. So let's talk about 2008 and how the housing markets came down like 20%. Everybody was like, I have no equity in my house. And then things got better. And now we're to the point where things are starting to equal themselves out. So it's balancing our market, if that makes sense. So you've got more normal average rates. Of course, we want them to come down to 6. We want them to go into 5s, and we'd love that. That's awesome. But we're really starting to balance that out with housing prices, because even last year you were seeing housing prices increase, and that's not going to sustain for very long. Eventually the market has to sustain itself, and now we're balancing it.
And it really started balancing itself in 2017 and went all the way through. Angie and I just did some research, and I think we might even have a graph that shows from 2017 to today, and you do have the COVID in there, it will show you a graph where it's starting to moderate itself. So you're starting to see stabilization of the housing market. With what does that mean? That interest rate is starting to stabilize. Housing market starting to stabilize. Is it still a seller's market? Yes. Is there still need for homes? Yes. So in 2017, you would see the same podcast that you're seeing today. It's still a seller's market because there's not enough homes in the market for buyers. So buyers, we're always going to have a need for homes for buyers. So now that brings in the big scary word, tariffs. What does that mean for new construction? What does that mean for housing? For you, for us, that means how new construction is actually on the uptick. So for my buyers, new construction is probably something that we want to look at because they're going to want to do some, I don't know what kind of, what's the term? I'm
Incentives.
Incentives.
Well, and right now, new construction nationwide is like 31.4% of the active houses on the market, and that's new construction, which means tariffs are going to increase the items. They still have to build them, but maybe you are looking at incentives. A lot of these new constructions are going to do incentives, especially those that are already built.
Yeah, absolutely. Absolutely.
And then the other word that we wanted to touch on, and it's always scary, is that word recession. And the last time that our country really experienced a recession, it was directly tied to the housing industry. And now it's not directly attached to the housing industry. It's a lot of other things. Can you talk to that a little bit?
Well, first of all, is there going to be a recession? Yes or no?
Did I mention?
Oh, okay. Wait, did you pull it out of our backpack? Yeah.
You know, it's one day. Somebody from the Federal Reserve the next day, and nobody knows.
Nobody knows. Somebody told me just move forward.
For whatever reason, whether it's unemployment, inflation, et cetera, et cetera. Is it going to happen? Again, we don't know. One thing that positively come out of a recession is stimulus. And one major stimuli to the economy is the housing market, right? One factor to get that really ignited is to drop interest rates. So that is a potential side benefit. So, but again, no crystal ball. It's tough to tell right now. There's a lot.
Well, and I know that there is a push to lower interest rates, and so I think there is going to be something that we're going to see. Which obviously, your National Association of Mortgage Bankers is talking at that, and that's a drop of like 0.5% to 0.75%, which doesn't sound like a lot, but when you're talking about hundreds of thousands of dollars, it actually is a large number. So that's awesome. And who knows, maybe next year or the next year we might see it at 5%.
Yep, absolutely.
And the other thing to remember too is that we don't know that these tariffs are going to stay, how long term they're going to be. So it's really important for everybody to just don't panic, don't read the headlines and get scared, because you just need clarification. And at the end of the day, we've all lived through all of these changes before, and everything's okay. You just have to make sure that you have professionals that you can depend on that are going to help walk you through it and take care of you through the process.
And going back to, that's what we spend our hours working on. We spend our time reading, studying, and researching. To go back to that recession in 2008, there were no homes. There was no, what am I trying to say? There were no homes to purchase.
Well, it was crazy in 2008, because what was happening is that they had all these people that were letting their houses go. Because the problem was in 2008, they were giving everybody who had a pulse a mortgage. And at some point, it's gonna implode, and it did. And it was really sad, because as a real estate agent, you're doing these showings on these houses. I could do an entire episode just on the grossness. Like, people were taking furnaces. We live in Minnesota. They're taking their, like it was the bank's fault that they foreclosed because they couldn't actually afford it, because they probably shouldn't have even had the house to begin with. And all of these houses are now foreclosures, being sold by the banks. They don't have furnaces. They are trashed.
Yeah.
It was 2008 was devastating, but that was because they didn't have a hold on the mortgage industry like they have a hold on it now. So recession is not going to look the same
No,
as that
Americans,
at all.
we
That was
learn
completely
from our
different.
mistakes. We learn what we're going to do different. So did the contracting industry. So did the business industry. So did the lumber industry. So all of this is going to move forward, and the lending industry. That there's a lot more I's to dot and T's to cross, and that's again moving us back to the three people sitting at this table. Contact us. You're going to see some emails on the bottom of this podcast. Reach out to us. One of the things that this Let's Chat is all about is telling you the truth, being honest. Do we know if there's going to be a recession? No. Do we know what the housing market's going to look like in 6 to 8 months? No, but we have a better idea than most because we're in it. We're in the weeds and we're doing it every day.
And we're still, no matter what, we don't have enough houses to accommodate all the buyers that are out there right now. It is just what it is. We have, Jim has clients that are pre-qualified and ready to rock and roll, and now they have to find the house of their dreams or investment of their dreams or whatever it is. It's always going to be a good time to buy. It's always going to be a good time to sell. Just depends on your situation and how your situation makes sense for you in regards to the real estate process. And that's what we're here to do. So anything else you feel is important to say to our friends before we leave?
I was just going to mention one thing. People get so focused on just, the transaction of the mortgage, getting a house, making a payment, and working with a realtor. When I work with my clients, I like to call out the wealth building part of home ownership, right? I'm not going to spend a half an hour, so don't worry. But even when I work with an applicant, I'm trying to position them in the best way they can, whether it, if they have a chunk of money, should they use this towards the down payment or should they pay off debt to get them into the perfect situation, right? But even outside of that, looking at it at a more macro level, wealth when it comes to home ownership, a huge percent of your overall wealth has to do with the house that you own, the house that you own. Yeah. And just looking at stats, 4% appreciation on an annual basis. If you take a $300,000 house, you're looking at 10 years, $150,000 in equity based on 4% appreciation, which is the national average.
Yeah.
So I like my clients to not just look at it as a transaction and just only the excitement, which it is exciting getting into that new house, but just their overall wealth picture.
Yeah, I love that.
For sure. It's the biggest investment of your life. It's your home. It's an equity builder. And another thing to just touch on when it's talking about equity, another thing that Jen and I had learned through, and if you are ever wondering what good podcast you might want to listen to, Tom Ferry, for those of us that are in the industry, he's another one that we like to follow on YouTube, and he's on others. But he just recently had a podcast out, and he talked about how many people have an exceeding amount of equity in their house. Like how amazing and exciting homes that have 50% equity is 30%. 30% of the nation has 50% equity. It's crazy. Owns free and clear. Like, way to go, everybody. 40% of people. So, whether you have had your house for 2 years, 3 years, 4 years, 20 years, like the amount of equity that people have in their homes just because of the way that the market has been, it's really exciting. And that's another thing to just touch on, how the recession isn't going to be the same if we do have a recession. It's not going to be the same as 2008 because this is a completely different scenario. People are in better interest rates than they were back in 2008. People are in more equity positions with their houses. A lot of people, have those low 3%. What did you say here? Yeah, have under 6%. 82.8% of the U.S. mortgages are under 6%. So that's just, don't stress. Everything will be okay.
And every podcast, every research, every study that I have been reading is saying if you're trying to decide what you should do, don't wait. I'm not here to decide that for you. My job, our job here is to give you the information give you our expert information and you make that decision. But if you're waiting for it to get better, if you're waiting for the economy to ... whatever that is, don't. Do what you need to do now. That would be the moral of the story. Do what's right for you. Don't wait.
And it all starts, honestly, with one initial conversation with a realtor or a loan officer. And from
absolutely.
there, 80% of your, I'm not going to say anxiety, but questions you might have, 90%, you're going to walk away educated.
Yes, right? And feeling better about making the right choice.
For you and for your family.
Yep, exactly.
Absolutely. Awesome. Well, thank you, Jim, for being here today. Jen and I super appreciate it.
Appreciate it.
Thank you, all of you, for being part of today's episode. And don't fret. It's all going to be okay. Yeah. We got this. Have a good day.
Thank you.
Bye.
Bye-bye.